Hello, everyone. I'm David Darst here on behalf of the Family Office. We want to bring you up to date on things as they evolved in the month of August. August was a rocky month. Okay, quite a bit of volatility. It started out strong, continuing the rally that took place in July. As you know, July, the Standard & Poor's was up 9.1%. In August, the Standard & Poor's fell 4.2%. So it turned around primarily and basically in the second half of the month. You had also NASDAQ. NASDAQ was down 4.6% for the month, and it is down 24.5% for the year. It is well into bear market territory, whereas the S&P 500 year-to-date is down 17.0%. The two-year Treasury closed at 3.45%. The 10-year Treasury closed at 3.15%, and the 30-year Treasury closed at 3.27%. The two-year rose 56 basis points in the month of August. The 10-year rose 48 basis points in the month of August, and the 30-year Treasury rose 27 basis points in the month of August. The German, Swiss, and United Kingdom 10-year bonds. I just want to point out the German 10-year now yields 1.33%. That's in euros. As you may recall, at the beginning of the year, that was negative 59 basis points. So you've gone from negative to positive on the German. The Swiss, the same thing. The Swiss went from negative 45 to plus 68 basis points. And that's, of course, denominated in Swiss francs. And the British pound gilt, similar situation, but it did not start off this year in negative territory. It's up from 231 at the beginning of the year to 268 in British pounds at the end of August. Oil. The West Texas Intermediate oil was down 9% to close at 89.55. It is up 19% year to date. And Brent was down more than West Texas Intermediate oil. Brent closed at 96.49, and it was down 12% for the year. You've got these conflicting forces going on. Supply is being driven by considerations relating to the Russia-Ukraine conflict, relation to the talks going on in Iran, to the situation in Libya. You had a delegation go from Iraq recently to Europe to talk to them about perhaps increasing supply. Consumption is expected to drop in the U.S., in Europe, and, of course, in China. We'll come back to China in a second. The Strategic Petroleum Reserve of the United States is down by 130 million barrels since late February, when they began to release oil out of the Strategic Petroleum Reserve. That's the lowest the Strategic Petroleum Reserve in the United States. That's in the southern part. It's in Louisiana. It's in Texas. The lowest it's been in 38 years, since 1984. It's not been that low. The big news of the month, of course, was August the 26th, Friday, August 26th, when Fed Chair Jay Powell basically delivered a very strong message, very short, by the way, 8-9 minutes long. People were expecting a much longer speech, but basically he said, we're going to be raising rates. We're going to keep rates higher than maybe the market had been expecting. And we're going to basically keep them up longer than people had been expecting. And there's going to be some pain involved. That word pain really triggered some of the sell-off in risk assets as the month evolved from that Friday speech. There's basically, people were expecting the Fed with inflation. Some of the inflation numbers have begun to come down a little bit. Consumer prices, producer prices, the personal consumption expenditures price index, all of those were beginning to come down a little bit. So people thought, oh, well, the Fed, certainly after the first of the year, can begin to switch towards easing and dropping interest rates. No, not right now. The job opening and labor turnover survey, that was released on August the 30th, almost towards the end of this month. And it showed 11.2 million unfilled jobs. That was up from the previous month, was 11.0 million unfilled jobs. So the Fed has a lot of wood to chop, or they've got a lot of things to do, because you've basically got labor costs with all these unfilled positions. That's basically helping to elevate labor costs. Yes, many goods, grains, petroleum, okay, certain industrial metals have been coming down in price, but services and rents, and of course, services includes labor costs, all right, have been exhibiting some strength. So that's really what the Fed's got to be focusing on. There are only 69 days until the November elections, November the 8th, national elections in the United States. So get ready for potentially some further volatility. The VIX index closed August at 25.87. 20 is the long-term average. That's not really highly elevated, but you've got quantitative tightening beginning to increase now. With the 1st of September, they doubled the rate of shrinkage of the Fed's portfolio of mortgage-backed securities and Treasury securities. You've got inflation still high. It's come down a little bit, but it's still high. You have the economy slowing. You have the Fed hiking aggressively. And you have Europe facing energy issues, and China has three things they're facing. The housing market and the real estate sector has been under pressure there. You have the COVID lockdowns, and terribly, I feel very badly, you've had the drought conditions, and that's leading to reduced power output because the water levels that run the hydro have come down significantly, and you have the similar situation of this hot weather right now in Europe. I'm sure when it gets cold in Europe, people are going to be wishing they had some warm weather. But this is an issue that is affecting China in particular. The housing, the COVID, and, of course, the power reductions. What are our recommendations right now? One is diversify. Stay with good quality. This is not a chance to go down in the quality portion of the portfolio. Mitigate risk. How can you mitigate risk? Number one, there's nothing wrong with having some extra cash and liquidity that you could put to work on a very disciplined basis as the market comes down. Private equity is an area that we here at the family office have focused on for years and years. Choose good managers. Choose managers that are experienced and have a good track record, and then get you exposure to sectors that have growth potential and have cash flow generation potential. We have in the liquid markets a focus on defensive, and that means yield-oriented stocks such as utilities, maybe some real estate, good quality real estate, and of course, healthcare. The three keys to a bottom in the market. Number one, we come back to what we said last month. Number one, you need to see a peaking in inflation and hawkishness by the world's central banks. Get ready for a big rate increase by the European Central Bank very shortly here in early September when it begins. They may raise rates 50 to 75 basis points. We will see what the outcome is. But you want to basically see peak hawkishness and peak inflation. We don't see that just yet. Secondly, we want the China economic situation to basically be improving and the COVID lockdowns to be reduced and get back to business in a normal fashion. And lastly, the geopolitical situation, we would like to see that calm down. The big 20th Party Congress of the Chinese Communist Party will take place October 16th, and we look forward very much to visiting with you next month. Thank you for being with us today.